This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Whitney Elkins-Hutten, Director of Investor Education for PassiveInvesting.com. And we're going to be talking about a spectrum of topics today with a good focus on the car wash investing spectrum. I know a lot of us have seen these things pop up all over the place, and anytime that we see growth of anything, whether it's a 7-Eleven popping up everywhere, whether it's a car wash, whether it's, your H&R blocks going up, or there's capital behind that. And if there's capital behind it, that means that there's investing and that there's money to be made in that sector. So definitely excited about chatting with you today, Whitney. If you wouldn't mind, give us a little bit of background about yourself and kind of how you came to be in your current role with PassiveInvesting.com.
Well, first of all, Alex, thank you for hosting me on the show. I'm so happy to be here and help our investors, understand different parts of the, passive investing arena, especially investing in cash flowing businesses like car wash. I wish I could say that I went to school and this is what I was destined to do in life. My adventure starts off in 2002 when I purchased a house with a significant other. My relationship fell apart about a month later. And everything was under my name, the title, insurance, everything, utilities. And so I stuffed the property full of roommates and, just hoping not to lose the property, and then quickly rehab the property. I mean, we're talking, it had green shag carpet, psychedelic daisies painted all over the walls, true fixer-upper. And sold the property 11 months later. And it wasn't until after I left the closing table, I was like, whoa, hold on. I just put $52,000 in my pocket and I haven't been paying for any of my expenses for the past 11 months. I was like, wait a second. There must be something to this real estate thing, because that was kind of, I made more money just as a side hustle on nights and weekends than I did it in my day job that had me traveling, sometimes 60, 70, 80 hours a week. So continued to do a lot of those live-in flips and house hacks on the side. Eventually figured out, hey, I don't have cash flow. Like this doesn't pay for groceries, so to speak, on a regular basis. So then a friend of mine one day said, hey, why don't you hold on to your rentals? Those flips that you're doing, hold on to one of them, make them a rental. I was like, oh, good Lord, that's an amazing idea. And so if anybody knows me, I'm a ready, fire, aim type person. So I was up to 40 rentals before I knew it. Then, the next level achievement was I needed to go bigger. So got a 52-unit apartment building, and then, started running out of money and needed to figure out, like, how can I, partner with other people in order to get deals done? And that's when I transitioned over to the private equity side of the real estate arena and did several projects. Now GP on 10 multifamily buildings. I have a myriad of self-storage, express car washes, real estate debt, other cash flowing businesses in our portfolio too. So nice. All that to say, I've done the capital raise piece also for private equity. And now I just love working with investors, helping them replicate similar results to what I've had.
Well, we certainly have a commonality in liking to work with investors. It's been a pleasure over my career to have been, working, since 2012 with people investing in alternative assets and seeing where the different, avenues of deployment of capital have gone, seeing kind of the rise of the private equity markets after the Jobs Act and how that kind of really lit a fire into the commercial real estate syndication space and private equity side. So excited to dig into this with you. So again, real estate comes in many forms and fashions. And one thing that people, aren't kind of realizing is that, the conjunction of real estate and operational business, there is a kind of a direct link to those when you start getting into larger projects like the like apartment buildings, right? It's not just buying a piece of real estate, right? There's an operational business component to that. Same thing with self-storage. Again, that's a different medium to look at stuff through, which I have found fascinating as well, of how those things have evolved and the different things people are doing. But to focus on car washes for a minute, because the the operational aspects and as well as the real estate component of these things is really interesting. So maybe let's kind of start where we should always start with anything is at the beginning, right? So what was kind of the first thing that piqued your interest into this market coming from the single family commercial real estate private equity side? What really kind of was the first thing that made you say, huh, let's take a look at this? Like what was really that catalyst?
Yeah, so it was about 2018, 19. At passiveinvesting.com, at that point in time, I'm at a sister firm, and we did a lot of JV partnerships and co-GP relationships with passiveinvesting.com. And the question really came down to investors, we were seeing cash flow compression, right? The cap rates were falling in multifamily real estate. The only way to get cash flow for the investor, which that's what they wanted, was to put floating rate bridge debt on some of these properties. We all know how this story ends. Anyway, so we took passive investing, took a pause, took a step back, and they were like, wait a second. We're starting to see astronomical asset prices. We're starting to see this huge cap rate compression. It does not make sense to execute this type of business strategy for Class B apartments. Maybe Class A if we have massive upside and get it, significantly below value from the developers. What else can we provide to our investors that would, give ample cash flow, right? Allow them to, get a realistic yield in a safer way. And, it was from trying to answer that question, but also from, just trying to help people diversify their portfolio under the same roof. I mean, any LP investor should look at their portfolio and go, oh, I'm 50% levered, into multifamily real estate. Maybe I should add some other assets into here, right? Maybe I should diversify a little bit. So it was also a diversification play. So we looked at parking lots, we looked at laundromats, we looked at, all sorts of like lower maintenance cash flowing businesses. We already had self-storage in the portfolio. Then that's when it came across, this whole express car wash place. Car washes in general are a $33 billion and growing industry. So it's really in its infancy, likened to like self-storage was in the early 2000s. There's a huge competitive advantage right now for people that can scale a portfolio in car washes is that there's no third-party management. So it keeps big money out of the space too. So one of the challenges, if we were going to go in and start scaling an express car wash portfolio, we also needed to scale the property management company. So at the same time of acquiring these assets, we had to also scale the property management company. That way, when we did do an exit either to another private equity company or go IPO or a huge roll up to a REIT or something like that, they could take both at the same time. Or they could take the portfolio and know that it would be managed appropriately. So really about that 2018-19, we were just trying to strike the balance between, how do we get our investors more cash flow in a safe manner? Where is there less competition? Where can we do a little bit of blue fishing with our assets? And how can we safely provide diversification? Now, there's all sorts of ways that you can get into car washes. There's really 4 different types. There's the cement wall where you drive your car in. You drop your quarters in the wall or now scan your credit card. Not very scalable. Then you've got the other end of the spectrum where you have your full service car washes, which are very labor intensive. We knew we didn't want that. Then you have your self-serve car wash, which is essentially just a cost center for a gas station or maybe a lube center where you can only get 1 or 2 cars through at a time. So really it was this new model of express car wash where you have a tunnel that's about 80 to 120 yards long. You can wash 400, 500 cars a day with, say, 2 or 3 full-time employees. That was pretty new at this time. Now, one can argue we're seeing these things pop up all over the place in major metropolitan service areas, and that's fine. Let them do that because people have cars everywhere, like in the secondary, in the tertiary markets. That's totally fine. Let those guys have the urban corridor. We don't care. We have a handful of those properties that are well established in the urban corridor, but our main focus is in the secondary and the tertiary markets because most Americans, I think it's something crazy, like 72% of Americans have at least one car. Like over 50% of Americans have 3 or more cars. And very few people actually wash their car in their yard anymore. And that might be because of covenants. They can't do it. HOA doesn't allow them, or they just simply don't want to do it. Why wash your car in your yard and take like a whole hour on your Sunday or 2 on your Sunday afternoon when you can get a superior wash in 5 minutes through one of these, technology enabled tunnels?
Nice, yeah. So, from the perspective of kind of coming from the beginning, again, the main lens that you were looking at this through was kind of diversification, right? Because exactly to your point, people think, uh, when it comes to private equity, especially investing in real estate, again, it's all well and good. Like you can diversify, like, what class of properties and what city you're in. But at the end of the day, like you're buying real estate, right? You're buying rental real estate, whether it's an apartment, a duplex, triplex, single family. It is real estate and it has market factors that will affect that as a spectrum whole of just, rental real estate if you're looking at that. So again, I like the kind of the initial catalyst being diversification, right? So you going into the self-storage and then, looking at the cash flowing businesses, the component that I found kind of interesting was talking about the no large scale management. So with car washes, again, that not being there, so kind of having that competitive edge to go in and build that out to package to either for facilitate an exit, but and this is something I'm kind of a small question, but so there is large scale management for things like laundromats. Is that correct? Is that what I'm hearing?
That I'm unfamiliar with. I couldn't exactly say. Laundromats though have a level of automation. Same thing with self-storage. Like you don't even have to have a person on the premise
Okay.
at all.
Gotcha.
Also, and you're dealing with regular maintenance contracts, so as long as your facility is regularly maintained, you might just have to have somebody that lays eyes on it maybe one time a week.
Okay, gotcha.
Okay.
It was just a quick question because I heard
Yeah.
you mention it, but yeah, just probably in your course of looking at this. So when it comes to, again, you have the several different avenues that you can look at. Now, did you initially come at this from a like ground up development, like you're looking at the dirt and then building it out, or are you doing a reposition play? Like what was kind of the initial crack at this when you got into the car wash business?
Well, in order to kind of like test the model, it was like buy then build, right? So let's go acquire some of these, mom and pop, original build. So say somebody was very excited about this and they're listening to this and they're like, I want to go do my own car wash. Fantastic. Go find your piece of land. Depending on where you live, that might be $1 million. And then, sink in about another 3 to 4 million or more in equipment. So your cost basis is probably all in for like $5 or $6 million. So pretty low cost basis. The catch is that as a mom and pop owner operator, you probably need to have somewhere between 7 to 10 facilities before you could actually afford to hire a regional manager. And so they just can't achieve this economy of scale. How are they going to get, capitalize, a $50 million acquisition over and over and over again in a short timeline in order to outsource that management? So most of these mom and pop operators never made it past like 2 or 4 sites. And so that gave us a unique opportunity, for us to leverage our investor network and our skills that we already had built interiorly managing, we do third-party management of our hotel our hotels, our self-storage, as well as our multifamily, but we had the capacity internally to manage them if we wanted to. It just didn't make sense to do that. So we had reserves on our team to start building out this management company immediately. And so that's what we did. We started acquiring the first handful of properties, repositioning them, rebranding them, in some cases maybe retooling the tunnel a little bit, optimizing how they utilize water, how they utilize the chemicals, how they utilize the electricity to get some operational efficiencies, and then standardizing the protocol across all the facilities. We were able to get that done in a relatively short time period, like 6 to 8 months. And so we had that capacity, and most mom and pop operators just don't have that capacity. So our first 28 acquisitions, well, actually, I should take that back. It was like right around our first 22 acquisitions were buys. And then we were like, hey, I wonder, like, are we ready to build? So we bought 2 parcels of land in 2 different locations and started building our own car washes. We quickly determined that one location was unfit. And so we flipped that parcel of land, made a good return on it for our investors. And then we kept the other one and did a ground up construction. And so moving forward, we'll probably do some sort of combination of acquisition and ground up construction, having proved both models.
Okay, gotcha. So the general concept is, again, you're buying from dirt to the shingle, right? You're getting the whole thing. You're either, if you're going in, you're buying the business. You're not really looking at something that has like a land lease or anything like that. You're looking at
We want to
owning
own the
everything.
whole thing. I mean, because that de-risks a lot of the investment for the investor, right? If there's like some sort
Mhm.
of land lease, and what happens if it expires in year 7,
Yeah,
unless we.
exactly. Yeah, and also I'd imagine just from the aspect of the security of it all, right? Like, you own at the end of the day real estate, right? Let's say if the market sentiment changes completely and everyone's like, you know what, none of us are washing our cars anymore, you still have a piece of real estate you can retool or exit on, right? It still has inherent value. So if you're only kind of betting on the business, you're at, have that market risk. Is that going to happen? No. I mean, we may not have gas cars, we might have electric cars, but people are going to be needing to get to places in the United States. Like we love our cars. I love my cars. I fall into that category of people that owns too many of them.
Well,
Uh,
here's the thing. Electric cars still need to be washed, so we don't care about that.
Absolutely, yeah. Yeah. I'm downsizing the fleet a little bit, but it ebbs and flows. So let's talk about some of the things that you kind of initially cracked into this. Again, the management component I find the most interesting from the fact of when you talk about, real estate. Again, I think people can understand that you have a business that has a need, right? People want to wash their cars, right? Do you need to wash one? No. But again, no one likes to have, a million layers of dust on their car. People typically like to keep them relatively clean because they're not the cheapest things in the world. So again, you have that kind of market need for this, but the advantage on being able to build out management for this stuff I find pretty interesting. So I'd imagine that the management concept for a car wash, again, being significantly less overhead than an apartment building, right? You don't have thousands of people or hundreds of people that all need a new toilet, or the door handle breaks, or hey, the drywall needs to be patched. Like, it's kind of lean from that perspective, but I'm assuming there's probably definitely some lessons you learned that maybe you didn't think would be an issue that did, or just kind of some interesting things that you learned on building out the management for this type of business, that maybe didn't necessarily correlate to what you were used to in the like commercial multifamily space.
Yeah, so there was a couple of things on the operational front. We've got the actual how does the facility operate, and then we got the people part of it, right? And so, some of the early lessons were around the actual, like, do we want to buy a facility that has a conveyor belt or a chain? How old does it want to, can it be? Are we always prepared to replace the water capture system, or is that something that we want to have like built in? So it's kind of like, initially buying, your first pieces of real estate, you're going to learn the first so much on the first transaction. And then you're hopefully you have a very solid due diligence checklist. And then you're going to continue to add to that due diligence checklist the more acquisitions you make, to where eventually your funnel gets very, very, very narrow. So that was, a lot of like, we dialed in the operational efficiencies rather quickly, what we wanted to see. The people side of things, there's 2 parts. It's like not only the managing of the car washes, but also how did the team work with trying to get increased subscriptions on the facilities. And so I'll start with like just the actual management. We actually kept majority of the teams that were already existed on the properties, and we worked really hard to not eliminate any jobs, but really like incorporate the existing team into our systems and, identify who could internally be promoted. And so that was something that we were to this day, we're still very driven to do in our acquisition process. However, it's not always does somebody want to like switch how they did things, right? That was the one thing that we really asked people, was like, kind of forget what you know about operating this car wash and then like step into the new world with us. We're ready to have you. So that was a little bit of a bumpy ride, and getting the right, people in the right seats on the bus. That took about a year. But I would say right now we have a team that's humming along incredibly well. We also had to take a look at our vendors. One thing that we quickly brought in-house was all the mechanical repair. So we built out a team that could travel to our locations, and if a belt broke or something like that, they could do the repair. The key piece for that is so we didn't have long downtimes on our facility. We had a weather-related issue on one of our facilities in Alabama. I mean, who thinks Alabama is going to freeze over? It did. Yeah. And so we had a downtime of 21 days waiting for the right mechanics to help us on that property. And we're like, no more. We're going to have everything built in-house. And then another big lesson that we had with our team working with acquiring subscriptions, we really thought more of our customers would be more tech-driven, enabled, but they weren't. They really liked having somebody stand there and literally push the buttons for them on the keypad to get them registered for their subscription. But now once we did it and once we trained them, they're golden. But that was a really eye-opening experience. For us, we're like, why aren't people upgrading their subscriptions? It's because they just didn't want to take the time or couldn't take the time or couldn't read. I mean, I normally wear bifocals. For me to read a screen, I'm like, forget it. I'm like this all the time. So really doing a lot more of that customization and hand-holding in the early opening phase of that car wash went a long way with our customers.
Now, from that technology aspect, so two things. Let's kind of start at the beginning, and then we'll kind of work with the second question of the model of this, right? So normally, I guess when people think of, when I think of a car wash, I think about, again, going there and whether I'm using the bay with a self-serve one, or if I'm going through a wash, I think about just point of sale, right? I go swipe my credit card, drop my quarters in, run it through the machine, we're good. But is this something that you focus more on a subscription model for your revenue, as opposed to just point of sale? And what was kind of did it always start from that perspective, or was that something that you grew into?
So it actually requires a balanced blend of subscription revenue as well as individual sale of car washes. And so, we initially liked seeing or picking up acquisitions where the mom and pops had 0 subscriptions. So that gave us we could initially move over 75-80% of those existing customers to a subscription model. But in order to really boost NOI growth, growing subscription models, you get this huge influx in the early stages of that transition, and then sometimes it's a slower growth after that. Whereas a lot of people want to test drive something before they buy. They don't want to just jump in to a subscription. My husband, if we had an express car wash here in Boulder, Colorado, he would totally have a subscription for every single one of our vehicles. Me, I'm only going to wash the car every 4 months. I drive him nuts. He's like, the car is dirty. I'm like, who cares? The inside's clean. So, really helping, working with the financials, working with our internal asset management team to understand what was that balance between subscription and single pay that we needed. Now we have to, when you open a facility, we can't come rearing out of the gate with our target subscription level, right? We have to essentially get the customer base in, get them loyal, and then we can start moving them up the income chain to get them to the subscription level that we want them at. So for example, we probably, in the market, the subscription might be $35 a month. We might get them in at $25, $27, $30, and then start working them up to the competition. Not much unlike self-storage or multifamily. Mm-hmm. You might just be a little bit below market, and then eventually the market's going to start increasing.
Yeah, and again, and I think generally customer bases are amenable to, seeing an incremental increase, right? You don't turn the heat up at, maybe it's a bad example, but again, you don't just kind of come right out the gate with your target, right? Especially if that's going to be a metric, like a perceived like significant increase on what they're paying. But if you bring additional value, additional things, better quality, you can justify that and kind of ease them into it, right?
Yeah, like free vacuums, free scents, stuff like
Mhm.
that. On a couple of our locations, we have dog washes, which I love that idea. I have an 80-pound baby, furry baby, and
Oh
so
yeah,
she can totally mess up a place really fast.
yeah.
So those are the type of like free amenities that we layer on that a lot of our competitors actually charge for. And so it is a unique model, and there's all sorts of things that you can do to, provide value and to make that subscription even more valuable.
Yeah, now again, I get it. The dog wash thing is fantastic. I don't understand how my dog actually has any hair on his body because anything he touches is just like blows me away. But so to the point of kind of let's looking at demographics, right? Because when you mentioned that when you have the kind of the learning point being that you didn't realize everyone just didn't want to like update it on their phone or just kind of go through bing bing bang, I'm done, I'm here, not necessarily having to need that person manning the car wash, being like, hey, here, 1 2 3, swipe the credit card, changing things. Was that more just kind of a general concept, or was that more kind of demographic based? Because I would imagine, again, just in general terms, I would imagine that the people that would want that more human interaction would probably be your older demographics, probably your 55 plus. And I would also think that those would probably be the people that utilize these car washes more. I know, at least for, I'm 36, people that, at least in my general demographic, we don't go to those car washes. We, wash them ourselves. Not as much as I probably should, but again, I typically do it myself. But I know my parents, my grandfather who's 91, they love that kind of stuff. So what's kind of the demographic spread that you see for the people utilizing your car washes?
Yeah, at our last directors meeting, I have some anecdotal data, not the hard stats in front of me, but when we talk about who's utilizing the car wash, I mean the spreads, pretty balanced between say like 20 to 60, 70, right? But we do see a couple of upticks like in the late 20s into like the 35 arena, 35, 40 arena, and then we see that kind of uptick in the retirement. One is in their professional career where they might be realtors, they might be doing business out of their car, actually, right? They're taking clients to lunch, they're taking clients to, like a realtor to different locations. They might be an Uber driver or a Lyft driver. And then we see kind of that uptick in retirement, maybe more time. I don't know exactly why. As far as who needed more assistance at the actual kiosk, I mean, there was no clear breakdown on that. I think that a lot of that has to do with actual time and attention, right? Somebody's coming through an express car wash because they want to take an hour and a half long process and distill it down into 5, 6, 7 minutes. And then now you are looking at a screen that's asking you a bunch of questions in order to like get registered. They're like, just buy,
Yeah.
right? They're not sitting there filling out all their information. But if you can make that process as friction free as possible for them, then that is, we're actually providing a service for them at that point.
Yeah, again, I think the the general consensus with a lot of people in any interaction with the business is that it's gotten so sterile for a lot of things, that if you can add in even a little bit of human interaction or customer service, I think it pays off in spades. Especially what we do here at Advanta, it's kind of been a problem in the self-directed alternative asset administration realm, is that everything's gotten so sterile. It's like press 3, press 4, use this online portal. And we found really good success with having that human interaction and dealing with clients directly and helping them through this stuff. So I kind of see that permeating through a lot of different industries. And to that point as well, I definitely see that as a value to kind of what you're doing, because I think, again, anecdotally, like even if I'm in a car, like I like tech, like I don't mind it, but having to utilize a computer screen through my car window, like, if I'm driving my Jeep, I'm like staring down at something, or if I'm driving one of my other cars, I'm like going up, like it's just not people behind me. I don't want to deal with it.
You should see me trying to leave the airport and pay.
It's
Like
it's
just a credit card kiosk.
I don't know what, like at Tampa's airport, I don't know who decided on these things, but they have them set back from when you're getting out of this long-term parking. Like they have them set back so far. I don't know how, like I have to always open any of my cars. I have to open the door, like lean halfway out. It's, yeah. And they were like, this is a great idea. No one's going to hit them. Like no one can use it.
I
So
totally agree.
totally get that. Um, so again, now let's, as far as kind of strategy goes with this thing, 'cause it's all well and good to look at this as saying, hey, look, we can make money on this, right? But, or I should say, my first question is, how long have you kind of been in this space? Like, what's your time horizon so far?
Yeah, so we're about 3 years in from
Okay.
our initial acquisitions.
Okay.
And so, the past year, the first 2 years, we were in heavy acquisition mode. This last year, we've just been, with interest rates being where they're at, we're looking for them to drop a little bit more. We've been in just stabilization mode. And so just really focusing on what we have. We have 30 properties to date. That's a nice mixture to keep our property management company busy. It's not quite large enough to get the exit that we want. So, we need to land somewhere between 100 to 50 locations. And so once we get everything dialed in at the property management company level, then, it's going to be off to the races for scaling. We actually, our second to last acquisition, we actually, tested moving out of market. So we've created this hub in the Southeast. And then we went to move and create another hub in Texas. And a few different things, reasons why we didn't go through with that transaction. One of which the seller actually did not disclose a lot of issues with the property. So that was an immediate. Yeah, that was fun. But anyways, even then, it gave us the opportunity to really think, okay, like here's where we are in the market. Do we really think interest rates are going to come down in, 2024? They didn't. And so we're just like, let's take a pause. Maybe this is a blessing in disguise. Let's take a pause. And it wasn't so much that those deals were terrible deals and we shouldn't buy them regardless. I mean, the obstacles were not insurmountable. But the opening up a new market in the middle of where we were in kind of recessive a recession, is what I'm going to call it in real estate, just wasn't a smart move. So we've really been retooling, re-engineering. This gives us a lot of ample opportunity to get our other hubs, locations all set, ready to go, or vendors in place, and then we can start acquisitions.
Gotcha. So to that point, you kind of brought up a good segue into the next thing I want to ask you were location based. And to that point, additionally, like when you're doing these, are you trying to like be specific, location specific and branding be unique between all of these, or are they all just kind of like individual, like kind of like I guess just like no particular like co-branding with any other locations, or are you trying to build out the different locations with a certain brand profile between all of your operations in that particular location?
Yeah, so our brand is Hurricane Car Wash. And
Okay.
so the different levels are category 1, 2, 3, and 4. As far as the subscriptions, that joke lands really well, like on any of the coastal cities,
Yeah, down here
somebody.
in St. Pete, Florida, we got two hurricanes last year. It was so much fun.
Not fun, haha. But
Well,
I'm just
we
saying people
appreciate the
get
time.
it. They understand the brand, right? So would there be an opportunity for us to introduce a separate brand in, say like if we expand into like the Dakotas, possibly, but we're going to, there's so much opportunity. Location wise, brand wise, with our current brand, like I think we're going to tap that one out.
Yeah. So to that, now is this something so like if so again you're kind of looking at these like as a general like so we're investing in this certain area with that now to the kind of the investor side of things is that basically meaning that if you're raising capital or bringing in investors they're all going to be like coming in to this as a certain like location specific, are these all packaged under one or do you break them out into different offerings?
Yeah, so we because just the purchase size of them are somewhere between $5 to $9 million purchase size. It really lends well to acquiring or grouping together, say 2 to 7 properties together in one portfolio package, and then taking that whole package down at one time. It does require us, to be a little bit more thoughtful with our letters of intent and our purchase sale agreements and line up timelines, but it's totally doable. We, at this point in time, don't necessarily want to move to a blind fund. We did that in the self-storage arena. And then our second fund, we did like, portfolios of properties. And, investors, I get it. I'm the same way. I'm a limited partner investor. I want part of de-risking my investment is actually seeing the property that I'm investing in, not just investing in a thesis.
Yeah, and that's a really good point too, especially when it comes to, again, mitigating some of that market risk as well. Because, if you have, a very strong market in somewhere, you can be like, okay, cool, there's a little bit more stability and growth in there. Or if you want to maybe take a little bit of a hedge on saying, hey, this could be really good, but it's a little bit more untested, I can kind of mitigate that risk profile across different things instead of just saying, hey, like, the aggregate average of risk for a pooled fund investment, whether it be evergreen or whatever is being packaged together, there's a lot of faith, but you also kind of you lose part of the stability, but you also lose part of the upside. So it's just kind of just a middle of the road, which is nothing bad with that. But again, with, looking to really kind of specify, especially in the private space, I really do enjoy that kind of, broad but narrow approach to this, which it sounds like we're kind of in agreement on that as well.
Yeah.
So,
I mean, we have done, say like a 5-unit portfolio, and we've left like unit number 5, kind of like a little bit of a mystery. And it's because we have multiple LOIs out and we're trying to figure out which one of those guys are going to go through so we can put that one into the portfolio.
yeah.
But we like offering investments that we want to invest in.
Mhm. No, for sure. So when it comes to kind of like the ultimate strategy for this, again, it's always tough, especially if it's kind of, again, you're still in that, you said 3 to 4 years is kind of how long you've been in the space for.
Yes. Yeah.
Yeah.
Well, I mean, like that from our 3 years since our first acquisition, and we're looking probably at a timeline somewhere like 5, 7, 10 years before we do any sort of exit.
Gotcha. So and again, exit, so like, I would imagine it'd probably be some type of like acquisition for that. Like you build a portfolio and ideally it gets acquired because now you've built in that management that makes it attractive to more institutional investors to come in because, institutional investors hate having to build anything, right? They buy, they don't build from that perspective. So, it'd be really interesting to see how that market goes because I've talked to one other individual regarding the car wash space, and it was a little bit higher level. We didn't dig this kind of deep into it. It was definitely kind of a primer to the topic. I think it was about 2 years ago. So it's definitely kind of a primer to the topic of saying, hey, here's, what we do. And they were just straight up, no mom and pop. They just wanted dirt. They were building ground up. They had no interest. They were wanted their whole system. But again, good for them and not pass judgment or anything like that. But kind of getting into the aspect of, what does this look like down the road is always, something interesting to discover.
Mhm.
Now, I know another big passion of yours is debt. So I don't want to make sure that we kind of cover some of the aspects of debt as it applies to this, as well as it applies to other things that you do. So I think that's, especially for the people that are interested in real estate centric investments, is something that if you leave it out of a conversation is doing a disservice to the listener. So when it comes to, how debt integrates into this, is this anything, fundamentally different than what you would normally see with like a normal commercial, say normal, but like with a typical commercial multifamily acquisition? These things are packaged together. You raise down payment, finance it. Is there anything that new or should say unique to the financing side for the car wash space?
They do qualify in some cases for SBA financing, which, on your residential real estate, you don't necessarily get that type of lending terms. We typically haven't done that because the rates have been higher. Close times, typically be like closer to like 90 to 120 days. So we can actually use different types of debt and be far more competitive, say like with a private insurance company or a REIT, some sort of private bank. So there is opportunity there for, to get different debt terms or additional debt terms outside of just like your Fannie Mae, Freddie and Mac and your standard, 70-30, 60-40 type loan. But I mean, for me, when I, looking at this, at the end of the day, when you invest in an express car wash, you're still in the common equity part of the capital stack. You're still in the highest risk, highest reward part of the capital stack. So every investor that I'm speaking to these days, I'm pointedly asking them, tell me just 60 seconds, what all do you have in your portfolio? And I have only, I mean, probably out of speaking to like 200 people, in the past couple months, I've only found 2 or 3 people that actually have invested in, say, like a just total plain Jane vanilla fix and flip debt fund, no leverage, just cash flow, just something that would help hedge the volatility that's happening in their portfolio. So I think what I'm driving for is a lot of limited partners, especially if you've been investing in, syndicated real estate since about 2017. You're expecting one investment to provide cash flow, equity growth, tax benefits, the whole shebang. That's nice. But
Right.
you have to, you're taking on a lot of probably more risk than you
Realize.
should be doing. So, really trying to help people, prepare, better navigate what's happening volatility wise in today's markets, but also prepare them for the next volatile market. Because it's not a matter of if, it's just a matter of when.
Yeah, I think that's a really good point to bring up, because again, the aspect of investing into anything that we're kind of hinted on, specifically focused on the uh, car washes today, but you have a lot of, again, external market factors that can directly, whether it's rent rolls, whether it's occupancy in the self storage space, whether it's people, wanting to afford that luxury of a car wash. Again, and it kind of trickles down, through those and probably needs. The car wash being on the more luxury side, people need a place to live, right? So you can kind of hedge that that volatility risk and that risk, but at the end of the day, like there's still, again, some flux that can happen there. And that's one thing I do personally. And one of the reasons I wanted to kind of focus the last part of this on debt and what people should know about it because you're passionate about it is that, security and stability and cash flow that you can really see from the debt space. Because unlike a lot of these other things, if everything kind of, again, just, a ton of bad things happen, there is that risk. Again, being in a common equity side, like you have that big upside, but you can be carrying a lot of risk with it. Whereas with debt, again, if they're doing, senior debt, first position, debt fund style investing, at the end of the day, like there is remedy for the underlying asset, right? If the people stop paying, you can claw something back. So, with the aspects of debt fund investing, is that something that passive investing as well, you also package and are operating in the debt fund space?
Yeah, so we do the senior debt position in fix and flip real estate.
Mhm.
And the reason why we entered there is because it's far less volatile than like first position liens on like, residential type real estate. We have a company that does the residential type lending. We don't have a fund around it yet, but the fix and flip space, there's always a need for that money. It's less price sensitive. And so we really can provide our investors with a very stable return, depending on their investment level between 6 to 10% monthly cash flow, and they can allow it to compound. Zero leverage, that's the other thing. So I know a lot of investors, when I get on the phone with them, they're like, oh, maybe I've been looking at other debt funds, but I can get, say, 9, 10% in this other debt fund or 11% in this other debt fund. And then we start taking a look at the asset mix. It's secondary positions, distressed debt, ground up construction. And then maybe that operator has gone to the bank to get a line of credit. And so that fund is actually levered. And I'm like, whoa, hold on. Do you know how much? Not all debt's created equal. Not all debt funds are equal. I was like, you just took on a position that I would probably put up in what I call my if I did, tier 1 cash being your reserves, tier 2, your cash flow, I would put that in upper tier 2 to tier 3 because you have a lot more volatility and risk because you're sitting behind the bank. Honestly, is something we're going to happen to that debt fund. So really just trying to help people educate, like this is something that I believe everybody should build out is their tier 2 cash flow in their portfolio. But try to stay unlevered if you can possibly can, and into hard assets that you actually can see and you can trust.
Yeah, exactly. And if you're good, there's always a place for leverage, right? But it's going to be one of those things where you really want to be able to see that upside equity appreciation, right? If you're going to take on that risk of having leverage within an asset, you need to mitigate that inherent risk with some type of inherent benefit. Whereas if you're investing into some type of debt fund product, it's all basically kind of fixed. They're depending on the blend of it and what the the interest rate market looks like, that you're going to see kind of a net average across most of it. Again, I would say like, between that like 6 to 10% range ish on what you're seeing on your return on that investment. You're not going to get like a 2x multiple on that. But if you're going to take a 2x multiple amount of risk, you should be able to get that upside. And one thing I would be curious to kind of get your thoughts on is that, you said you focus on the residential fix and flip market. And I think most people would think, well, again, that's a little bit more of a speculative play on the builder side or the developer, whoever, the economy of scale that's behind it not being necessarily important. But, they think, okay, well, you're building to a market, is there still going to be the demand for that? And especially with, like you said, there is definitely some recessionary things, if not a recession in the real estate market. So, but obviously there's still a need for cash, right? I would imagine, and correct me if I'm wrong, I'd love to get your thoughts on this, is that the reason that's probably a good place to focus is that the restrictions on traditional financing for those kind of development plays, they don't have as many options to go out there and just get a Fannie Freddie loan for doing a fix and flip or maybe a ground up construction that they would otherwise. So the market is a little bit more ripe to operate in there because there's that need for capital from that subset.
Mm-hmm. Yeah, I think you hit the nail on the head with that last comment. Just a clarification point, we don't do the ground up construction lending in this particular fund. We reserve that for a different, entity that our investors don't participate in. I mean, we have several businesses that we don't raise capital for, that we operate. But yeah, so these are, just think about it. These are going to be your 3-bedroom, 2-bath ranch homes, your 1960s builds. We like the Carolinas. It's where our team is. We have expanded out into Georgia, Alabama, and Ohio, and followed some of our fix and flippers out there. So we're just changing one variable, right? Not necessarily, still lending to the same person, but getting very familiar with the market with that person that we've already done a lot of business with. But so, this person's buying a property, finding a property, below value that needs probably an ejection somewhere between 30 to 60K. They're all in with us at 65 to 70% loan to value. So there's still a huge gap there, 30% equity there that the market can decline before anybody suffers a loss, or before we suffer a loss, or our investors suffer a loss. Now, the beauty of that is that, the loans are 6 to 9 months long. And so we are very nimble with the market. To see a 30% decline in any market within 6 months is just unheard of. So anyways, those are the type of loans that we're doing. And then, in the investor, the fix and flipper has to have a clear plan to exit, whether they're going to sell or if they're going to actually secure additional financing, more permanent debt on their property. And, we actually have another lending arm that's able to, if for some reason that investor is struggling to get permanent debt, we have another lending arm that can actually do the carry out loan. So we already are pricing that in, at market rate. So we actually know the end-to-end process of that particular deal. And so we try to limit the risk as much as we possibly can.
For sure. And specifically with the fix and flip, are you taking, so again, 90 to 120, you said 90 to 120 day term. So it's just really cross the finish line financing, or is it like?
Nope, 6 to 9 months.
6 to 9 months. Okay.
Yeah. So we're funding the purchase.
That doesn't make sense. So I did mishear that. Yeah. So 6 to 9 month financing. And then is it always, at least for your profile, always going to be first position senior debt on the property?
Yes. Okay. For this fund. Yes.
Gotcha. Yeah. Cause again, I think that, a lot of people, hear that, that's such a short-term loan, they might think, secondary or subordinate debt within something like that. And not what I would say if you're looking at this market as a whole. Be careful about that. Again, to your point about, some of the other funds that you've looked at with people that bring you stuff, if you're looking at something like that, yeah, short-term financing is out there. funds that have that kind of thing in there, but making sure, that the short-term financing is not going to be subordinate. And if it is, like, make sure you have that upside potential. Like, you make sure you're mitigating that risk profile with some type of upside that you can potentially capture on. Because a lot of, the short-term debt can be centered around, hey, we ran out of money, we need more. Well, maybe ask yourself the question again, if you're doing it individually or if you're talking to a fund manager, it's like, well, why couldn't they go to their original funding source? Like, what's the reasoning behind why some of these things are either being offered to me directly or why these are packaged into a particular debt fund? And get a good answer, right? Like, there should be a good answer for that, not a, oh, well, I don't know. It's like, there is a good answer for that. And may not be the one that they want to give you. And if that's the case, again, look at your operator, make sure you're doing your due diligence on that. So to kind of circle back a little bit onto the specifics of the part of the debt that you really like on there. When it comes to doing these, I know a big part of lending is not wanting things to turn over too quickly, but also not taking inherently too long. So what are the things, at least with this particular debt fund that we're talking about, that is favorable to you as the investor? Are you charging, again, for the short-term stuff? I'm assuming, is it more than 2 points? Is there some type of additional fees that are captured on the back end for the satisfaction of it? What are some of the things that make it advantageous to operate in such a short-term loan model for that?
Yeah. So, I mean, this type of debt is not new. I mean, it's pretty standard for this space.
Mhm.
And so, just to paint a picture for the listener right now, is it's a 3-2 house, maybe like a 1960s build. Let's say it is the house that grandma used to live in. And so they have a flowered wallpaper, green shag carpet on the floors. I don't know, I have an affinity for green shag carpet, but they never put in air conditioning. The heater, the heating system needs to be upgraded. And so there's all these major mechanicals that need to be upgraded, or maybe the flooring's missing. I mean, we've seen that too. And so this house needs a ton of love. It may not even qualify for your typical Fannie Mae, Freddie Mac type loan, right? If you don't have flooring, you can't take that to Fannie Mae and Freddie Mac and get a loan, right? You can't just sell a house with subflooring. So there might be some major, deferred maintenance that needs to happen that would prevent them from getting a loan. Also, the cost of getting a Fannie Mae, Freddie Mac loan is very expensive. And so requires, and remember, this rehabber is going to take the property and they're going to replace all the flooring, the wallpaper, put in all the new mechanicals. And so they're going to drive value. And they probably need to close super fast. Fannie Mae is going to take 45 days to do that. They're not going to be able to be competitive and get this property. And so this type of lending allows a borrower to be the investor, to be very nimble, close very quickly, almost like cash. They can roll in not only the purchase price, but their construction budget as long as they drop below a certain loan to value on the project. And then they can be able to, work their magic, say in like a 3-4, month timeline that gives them a couple months breathing room in order to get it sold on the market or get carry out financing and flip it into their portfolio. And they've created an immense value equity in the portfolio because now they're going to take it to the bank and, either they're going to sell it and get a nice chunk of change in their pocket, or they're going to take it to the bank and potentially refinance out and have none of their own cash into the property. So this type of lending is been around for a very long time and is a very strategic type of lending product for somebody who's doing this type of value add. And, we really take care to look not only at the purchase, the as is purchase price, if we were going to have to take this back, what's the value of the house with no repairs? We're going to look at the actual budget that the investor has put together. And then we're going to do what we call subject to appraisal or valuation of the property. And so we're going to see what it's going to cost today, what we could sell it for today, what if we had to take the project back, what we could sell it for tomorrow after all the repairs. And so we're taking all that data into account and we're asking ourselves, can they get this done in that timeline?
Sure. That's fair. Certainly a fair question to ask. Like, hey, can you deliver on what you're trying to do? Well, no. It's like, well, then maybe this isn't for you. Now, when it comes to investors investing in debt funds, I know cash flows again are kind of what people are aiming for is stability and cash flow, and whether you're taking that out or you're compounding that back in reinvestment again. Not necessarily the point of the question, but specifically with at least what you've packaged together, is it something where this is being paid out on like a kind of a standard like pref payment schedule, or is it kind of a float that can take advantage? And again, there's risk and benefit to that of what the market interest rates are. Like, how exactly is the cash flow captured by the investor into a fund like this?
Yeah, so the way we have our fund structured is that our investor receives the pref right off the top before any expenses are paid. And so, somebody might ask, how can you do that? Well, to the borrower, they're, for this type of product, again, they're not price sensitive, they're time sensitive, right? They want to work with somebody that can close fast and get them their deal. And so, somewhere between 12 to 14%. If it's somebody we haven't worked with before, they might pay closer to 14%. If there's somebody we have worked before, they're going to be on the lower end of that scale. And then there's points for closing. And so really, the points are used to pay for the mechanics part of the business for us to be able to run all the loans, do all the due diligence, everything like that. And then the investor, whoever is coming into our debt fund, they are getting the first 6% of whatever the cash flows that are coming into the business.
Gotcha. Yeah, it's definitely always a question worth asking. I interviewed a gentleman on the private credit side, which is something I've never really cracked into before, and it's really fascinating to talk about, but kind of learning how debt funds can operate differently, because so often, at least in the private equity real estate end of the spectrum, it's boilerplate to a fault almost. It's like, hey, like everything's kind of standard, which good, bad, or indifferent, doesn't allow for a lot of creativity a lot. And something I really enjoy about debt, one is the, stability. I think people, aiming for that stable cash flow is a very sound principle that a lot of people, can overlook sometimes. But also just the creativity and how these things can be set up. Do you want to capture, do you want to try to capture and offer your investors a little bit more of that upside risk? Do you want to be very, risk averse and offer a very stable potential, but potentially lower return on investment? There's a really awesome spectrum of how you can package when you're working with debt that, again, people just don't find it as attractive as they should, really. I think there's a lot of benefit to the debt side, and talking to someone like you that certainly understands and appreciates that's always very refreshing. And again, I would love to talk to you for hours on this. I think you would certainly have a lot more interesting and very valuable nuggets for our listeners. But my producers like us to kind of cap these and package these into about an hour. So, is there any kind of specific points that we didn't cover, either on the car wash side or the debt side, that you think would be key important pieces for people to take away?
I mean, just to sum it up, express car washes are a great diversification play to add a cash flowing business that has sound real estate fundamentals, to your portfolio, or at least how we do it. And on the debt side, I mean, I think a lot of investors kind of shy away from it because they want to see that equity, right? That equity growth. Just run the numbers. You can go to the compound calculator on investor.gov, government's website, put in $100,000, allow it to compound at 8%, which would be that would be the return tier for us at a $100,000 investment, and let it ride for 10 years. You would have a 17% return. You can get near equity like returns without taking the risk. And so, I'm not saying go all in on debt. I think that might be a little conservative, or maybe depending on where you are in your accumulation phase or cash flow phase of your investing, but it's definitely something to consider. I mean, the power of time and compounding is miraculous.
Yeah, and again, people, it's the tortoise and the hare analogy again. And if you have never played with a compounding interest calculator, you're doing yourself a disservice. Look at it and just like see what a reinvest structure and compounding interest can do, and not to have too much of a shameless plug, but if you do something like that through an IRA and you don't have to be concerned with taxes, because a lot of them, if you can set an effective tax rate too, like, your effective return, maybe you get 8%, but your tax rate knocks that down to 5.5 or 6. Like, if you can capture that whole thing and not have to fork it over to the government, also really awesome. So again, I think those are amazing points that you bring up, and I would highly encourage people to really kind of look at these two avenues as, if you aren't looking at that, if you aren't looking at, other alternatives in real estate centric stuff, such as car washes, again, really do look at it. If people are interested in reaching out to you at passiveinvesting.com, I think the website's easy enough to gather. But are there any other avenues specifically that you would point them to if they want to engage with your outfit to learn more or possibly invest?
Yeah, it's simple. It's on the screen, passiveinvesting.com. If you want to reach me directly, you can passiveinvesting.com/Whitney. And that you'll fill out a quick little form that'll get you directly on my calendar. It'll also put you into our queue for all of our weekly Passive Investing Made Simple masterclasses and our educational boot camps that we release on a monthly basis.
Awesome. Well, thank you very much, Whitney. The most valuable asset we all have is our time, because no matter how well we invest, we can't make any more of it. So thank you for taking an hour out of your day to talk to our audience. I really appreciate it. With that said, my name is Alex Perny. This has been the Alternative Investing Advantage podcast. Thanks for joining, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.